short video on required minimum distributions, or RMDs. As you plan for retirement, it's important to understand how RMDs can impact your financial strategy. RMDs are a crucial aspect of retirement planning, and we're here to guide you through the essentials. I'm Kelsey Davidson from BDA Financial, and let's dive in on what RMDs are, how they work, and why they matter to your financial future. An RMD is the annual required minimum distribution that you must start taking out of your retirement account after you reach age 73. The amount is determined by the fair market value of your IRAs at the end of the previous year, factored by your age and life expectancy. This is an IRS rule and not a company rule. Generally, RMDs start when you hit age 73. Your first RMD must be taken out by April 1st of the year after you turn 73. All other years, your RMD must be taken out by December 31st of each year. Here's just a list of retirement plans that require RMDs. For the Roth 401k, they did move away from this rule. However, RMDs are required on Roth accounts when they become inherited. Are there any exceptions to taking RMDs? Number 1, employer-sponsored accounts like 401ks, 403bs, or small business accounts can be exempt if you're still working for that company and that you don't own more than 5% of the business. The second exception is a qualified longevity annuity contract, which allows a portion of the RMD to be deferred until age 85. How are RMDs calculated? You're taking your prior year, December 31st balance of the retirement plan, and you're dividing it by a life expectancy factor. So here we have a table age 73 all the way up to 100, and you'll see your divisor listed there. On the next slide, we have a quick example showing Randy, who's now age 73, turning on RMDs. His December 31st balance is $160,000. Because he's 73, his divisor is 26.5. So his RMD for the year would be $6,038. Well, what happens if you don't take your full RMD by your deadline? There's now a 50% tax penalty on the amount that was not withdrawn. What to do in the event of a missed RMD? Well, first, let's fix the mistake as soon as possible and make the appropriate withdrawal. Then you're going to file Form 5329 to pay the RMD tax penalty. If you missed the RMD deadline because of a reasonable error, you may request a waiver with a letter of explanation when you file IRS Form 5329. And here are just 3 common reasons Bob and I have seen people missing RMDs. Not understanding the deadline to take their RMD, taking the RMD from the wrong account, and not taking the RMDs from an inherited retirement account when needed. So how are RMDs taxed? Once you withdraw your annual RMD, the money is taxed at your current income rate, and you may also owe state taxes on that money too. Any RMD distribution from an IRA must be reported on Form 1099-R. You must also report your RMD on Form 1040, which is your federal income tax return. How do RMDs generally work for spousal beneficiaries when the account owner passes away? Depending on when the spouse passed away, spouses who are the sole designated beneficiary can treat the account as their own, base RMDs on their current age, base RMDs on the descendant's age at death, reducing the distribution period by 1 each year. They can withdraw the entire account balance by the end of the 5th year following the owner's death. And Roth IRAs will begin to require RMDs if the owner passes away. How do RMDs work for other beneficiaries when the account owner passes away? So these beneficiaries would be considered non-spouse. You can withdraw the entire account balance by the end of the 5th year following the account owner's death if the RMD hadn't been started by the owner. The stretch window in a stretch IRA is limited to the maximum distribution period of 10 years from the date of death of the IRA owner. This would apply to most non-spouse beneficiaries when the IRA owner dies on or after January 1st, 2020. If the owner died after RMDs began, they can do the longer of the beneficiary's remaining life expectancy or the owner's remaining life expectancy at death, reduced by 1 for each subsequent year. And remember, Roth IRAs will begin to require RMDs if the owner passed away. Which account is the RMD taken from? You need to calculate your RMD for each IRA separately, but you have the flexibility to take your total RMD amount from either a single IRA or a combination of IRAs. However, RMDs from qualified retirement plans or inherited IRAs must also be calculated separately and can only be taken from their respective accounts. You do not need to take RMDs for Roth IRAs unless you have established an inherited/beneficiary IRA. If you're still working and you have an employer plan, the employer is still required to make contributions to your plan even though you are receiving RMDs. Here's just 6 strategies to help lower your RMD taxes. You can draw down your retirement accounts early. Once you hit 59 and a half, you can take money out of your retirement accounts without a tax penalty. Taking larger distributions in the early years of your retirement can reduce your overall account balance, thus lowering your RMDs later. You can consider doing a Roth IRA conversion. Roth IRAs offer the benefit of 100% tax-free qualified withdrawals and don't have RMDs. The Roth account must be open for 5 years and you must be 59 and a half to qualify for 100% tax-free withdrawals. You can consider working longer. If you have an employer 401k, remember you don't have to take RMDs from that account if you're still working, so you can push off those RMDs for a few more years. You can consider donating your RMDs to charity. The IRS allows you to donate up to $100,000 a year from an IRA without having to pay income taxes, and that withdrawal will still count towards your RMD. You can consider a qualified longevity annuity contract, which we discussed earlier. And you can check your beneficiaries. If you're at least 10 years older than your spouse and name them as the sole beneficiary on your retirement accounts, you can use the IRS Joint Life and Last Survivor Expectancy Table to calculate RMDs. So let's just recap on required minimum distributions. You must begin taking distributions from your tax-deferred retirement accounts by April 1st of the year following when you reach 73. All other RMDs must be taken by December 31st of each year. RMDs are typically taxed as ordinary income, and failure to take full RMDs on time can lead to a 50% federal tax penalty on the amount not withdrawn. Depending on which account you hold, there is a specific amount you must take from each type of account. And to calculate RMDs correctly and minimize taxation, it's important to talk to a professional. As you can see, understanding required minimum distributions is essential for your retirement planning. Remember, we're here to help you every step of the way. If you have any questions on what I've discussed today, feel free to schedule a meeting on our website, bdafinancial.com. In the top right-hand corner, click Schedule a Meeting. Don't forget to follow us on Facebook and LinkedIn, where we post regularly from financial planning and retirement tips to inspiring you on your home and health.